Is Dubai really a real estate bubble? I hear this claim all the time from investors in the media and even from people who have never set a foot in the city. But what is actually behind it? Is the market really heading for a crash, or are two completely different things being mixed up here? In this episode, we will look at the 5 biggest myths about Dubai real estate. And at the end, you can decide yourself whether Dubai really is in a bubble or whether most people simply misread this market. Welcome. I'm Eugen Zimbelmann from Dubai Finance, and I value this market week after week as an accredited valuer. Fair warning, with myth number 2, I'm going to make a few enemies today. And first, the sheer scale we are talking about. In 2025 alone, Dubai registered more than 270,000 real estate transactions worth a combined 917 billion dirhams, roughly 250 billion US dollar. This is not a niche market anymore. And yet, in almost every first consultation, I hear the same 5 sentences. Just last week, I sat across from a software engineer from London who brought up 3 of them in the first 10 minutes. So let's go through all 5 one by one. And at the end, I will show you how to spot a real bubble yourself. No value needed. Myth number 1, tax-free is a fairy tale. Hidden costs eat up all the returns. At first glance, this sounds like healthy skepticism. And skepticism is the exactly right instinct whenever someone promises you returns. It might surprise you to learn that the truth is even more drastic than most people think. When you buy, you pay a one-time 4% fee to the Dubai Land Department, and after that, the taxes that follow you at the home simply do not exist here. No annual property tax, no income tax on your rental income, and no tax on the gain when you sell. But what does exist are service charges, Dubai's equivalent of building fees, and they belong in every honest calculation. From 6 to 7% gross rental yield in the completely normal market average, you typically keep 5% and more net after all costs. Compare that with your home market. In the UK, an investment property triggers an additional stamp duty surcharge before you have seen a single month of rent. And in larger parts of the United States, you pay 1 to 2% of the property's value in property tax every single year forever. And before you object, but I still have to declare my Dubai rent at home. Correct. Most countries tax your worldwide income. That is exactly why at Dubai Finance developed a special appraisal, our REL valuation. Many of our German and Austrian clients effectively pay no taxes on their Dubai rental income anymore, completely legally, with the implementation set up together with the tax advisor. And similar levels exist in many other tax codes. At the end, I will briefly show you how it works. Until then, remember, a blanket, it's not worth it, is simply bad math. And that brings us to myth where I'm going to make enemies now. Myth number 2, off-plan with a payment plan is the easy, safe way for beginners. At the first glance, it sounds tempting. 20% down, the rest in comfortable installments during construction, glossy renderings, and every second broker on Instagram tells you this is the way. It might surprise you to learn that I, of all people, an investor living in this market, advise you against its most popular way of buying. In the first half of 2026, 71% of all transactions were off-plan. And you should read that number as a warning signal and not as a confirmation. Because in truth, with off-plan, you are buying a promise. Your capital is locked up for years without a single dirham of rental flowing. Its completion is delayed. The dry spell gets longer. If you want out before handover, you quickly discover that the resale market for unfinished units is far tighter than the seller promised. Just a few weeks ago, a buyer sat here who was caught in exactly that trap. And at handover, you compete for tenants with every other unit in the same tower. And before you think, but the escrow accounts protect me. Yes, since 2007 they protect your money from disappearing with the developer, but they do not protect you from years without cash flow, and they do not protect you from a weak resale market. My advice to you, buy completed, ready properties with a tenancy contract from month 1. Stay with me, because how little capital that really takes is the next myth, and it keeps most people out of this market entirely. Myth number 3, without millions in the bank, don't even bother. At the first glance, it fits the picture. Burj Khalifa, Palm Jumeirah, penthouse, making headlines, 8-figure prices. But in the truth, the entire math is far more down to earth. Take a solid rented compared apartment for 1 million dirhams, around 272,000 US dollars. We deliberately work with moderate leverage of 50 to 60%, so the investment stays stable through weaker phases as well. So you need 400 to 500,000 dirhams of equity plus 4% transfer fee, a good 120 to 150,000 US dollar in total. And for that, you own an apartment that produces rent from the very first month. Before you think, wait, leverage also increases my risk. Yes, exactly right. Which is precisely why we not 80% leverage or mortgage your unit, but 50 to 60%. That way, the rent carries the mortgage, not your salary. And my advice to you, what matters is not how much capital you bring, but whether the apartment carries itself from month 1. Before I get to the biggest myth of all, let's clear number 4 in 30 seconds. Myth number 4, as a foreigner, the property never really belongs to you anyways. Many people still have old models from other Gulf states in mind, where foreigners could only lease for 99 years at best. Dubai answers this question back in 2002. In the designated freehold areas, you acquire full ownership, exactly the same ownership as a local. Your name is entered in the official registry of the Dubai Land Department. Your title deed is issued digitally on the day of transfer, and this ownership can be sold, rented out, and inherited. As a valuer, I hold these deeds in my hands every single week. Legally, there is nothing to argue about here. Which brings us to the question this video started with. Myth number 5, Dubai is a bubble and it will burst like 2008. And I will tell you openly where I stand. Anyone who lived through 2008 has every right to ask this question. Back then, prices fell around 50% from their peak in the third quarter of 2008 within months, up to 60% in some areas. That was real and I wouldn't want talk it down. But in the truth, most people are comparing two markets that share little more than a name. In 2008, speculators bought stakes in properties that exist only on paper, on credit, and flipped them before completion. Today, real demand carries this market. Dubai passed 4 million residents market in June 2026, double what it was in 2011. In the first half of 2026 alone, around 121,000 new residents arrived, and every one of them needs a roof over their head. In the first quarter of 2026, 252 billion dirhams worth of real estate changed hands, 31% more than the same quarter last year. And the most perhaps important metric of all, you recognize a bubble when prices decouple from rents. In major Western countries, you often pay 27 to 35 times of the annual rental rent of an apartment today. In Dubai, depends on the location, 13 to 16 times only. Here, the rents carry the prices, the exact opposite of a bubble. It might surprise you to learn that the current geopolitical situation of all things is creating the opposite of a bursting bubble, a buying window. The tension around the Strait of Hormuz is unsettling part of the international owner base. Individual owners come under liquidity pressure and have to sell at short notice, while migration and demand keep running untethered. In our current acquisitions, we are securing completed properties in prime location 15 to 25% below market value, because we negotiate directly with the owners who have to sell. Short-term selling pressure among individuals and intact foundations behind it, that is not a bubble bursting. Exactly that is the constellation disciplined investors later call the right moment. My advice to you, as promised, never judge this market by headlines. Judge it by the 3 numbers that would expose a real estate bubble. The ratio of the price to rents, the share of pure speculation, and whether the population keeps growing with the supply. All 3 speaks a clear language today. So back to the question from the beginning. As one sentence to remember, you don't recognize a bubble by rising prices. You recognize it when reality stops carrying the prices. In Dubai, rents, migration and regulation carry the prices. Calling that a bubble is confusing growth with speculation. And as promised, the REL valuation from myth number 1. In short, as a valuer accredited by the Dubai Land Department, I developed it together with a tax professor. It stands on 2 pillars. A clean purchase price allocation, because in Dubai often 90% and more of the price falls on the depreciable building, and the remaining economic lifetime, which lifts your annual depreciation from 2 to roughly 4 to 5%. So far, every one of our REL valuations has been accepted by the tax authorities. And if you want to know what these 5 answers in the REL valuation means for your specific situation, your capital, your tax rate and your goals, then book your free initial consultation now, dubai-finance.com, and pick a date and time in the calendar. And if that analysis shows that Dubai is not the right market for you right now, we will tell you that just as openly.